The pandemic is causing more deaths and hospitalizations than ever now, and is expected to grow still worse in the days ahead. Millions of Americans, for the first time in their lives, are unable to pay their bills and face food insecurity. And yet, at the same time, amid all the grim news, the broad economy is doing fine. In fact, stocks have been repeatedly setting new all-time record highs. What's going on? We're going through a once-in-a-lifetime change in the asset valuation paradigm. An historic shift in the relative value of bonds versus stocks is underway. The virus has kept Americans away from restaurants, vacations, and entertainment since March. At the same time, a $2.2 trillion package of emergency federal aid triggered an unprecedented spike in savings held by Americans. Though the savings rate has come down from the initial spike in April, Americans are still saving much more than normal. The mountain of cash shows up in the nation's money supply, also known as M2. M2 is the cash held in savings, money markets, and short-term instruments, and it has gone parabolic. And another $900 billion in emergency relief is about to propel M2 higher still, adding to the mountain of cash. That pile of extra cash is expected to be spent or permanently saved in the weeks ahead, which is driving the change in the asset valuation paradigm. Bonds, the key asset class investors traditionally move cash into during times of uncertainty, do not seem at all attractive. A 10-year Treasury bond yields less than 1% annually today, and bond prices will decline when yields rise. The poor outlook for bonds makes it likely Americans will prefer stocks, housing, and other capital gain assets to bonds for the foreseeable future. That's why these assets have appreciated sharply in recent months. The changing asset valuation paradigm is what's happening now in wealth management.